Okay, I've set up the Baldwin Company example problem from the slides in the in a spreadsheet form. So for you can do this with every problem that homework problem for this chapter. So this Baldwin Company is actually more complex than any of your homework problems, so I figured it would be a good example. But the what are the things they provide us in the Baldwin Company example, they tell us sales are initially $5,000. They're going to grow to 8,000 in the second year, 12,000 in the third, drop to 10,000 in the fourth, and in the final year they're 6,000. The price per unit is $20 per unit. That's the sale price per unit, and it's going to the price of that is going to grow up at 2%. So we just take the $20 and multiply it by 1 plus the 2%. We can edit, see my formula there. So I'm just multiplying the $20 and multiplied by 1.02 or 1 plus 2%. So that, okay, so that gives you $20.40. You just drag that across and it's going to use absolute. It'll grow at 2% a year. Then our cost per unit is $10. It's supposed to grow at 10%. So we have create this formula, and at least the way my computer is set up, to get the absolute, you would just hit the function or FN key and F4. So you can see like that you want to lock in that cell. That's what those $2 signs do. Again, you just drag that across and it shows you what the cost per unit grows up to. And they also tell us that we're going to be using MACRS, or Modified Accelerated Cost Recovery System, over 5 years, which is actually a 6-year program. Modified Accelerated Cost Recovery is 20% in the first year, 32% in the second year, 19.2% in the third, and 11.52% in the fourth and fifth year, with a residual value of 5.76%. We will use that later when we calculate the actual salvage value. So, and then they give us an initial cost. Let's go across the top here. So the discount rate's 10% and the tax rate's 21%. Initial cost is $100,000. Increase in net working capital is $10,000, plus it's also variable. So they actually just give you these numbers, the net working capital. So the increases in net working capital are outflows, and then decreases in net working capital are inflows, and that's what this is showing right here. And the problems we have in homework, there are problems that reduce net working capital, and there are problems that increase net working capital. Increase is a cost, decrease is an inflow. And then the opportunity cost of the factory is $150,000. So we have a $250,000, $60,000 in initial cash flows. So, but now I have to use, this is, I basically set up an income statement here. So I've got sales, cost, depreciation, and I'm going to calculate earnings before taxes. My taxes use the 21% rate here. So sales is simply well, it's equals, or that's plus, equals, plus will work as well, equals C5, then that's our units, times the price per unit. So $100,000 in sales, I can highlight that cell and use a little cross and drag it across. So there's my sales. So my costs are simply the units times the price per unit. So hit enter. So now it's $50,000 in costs for the first year. I drag that across and I get the cost for the entire project. Now the depreciation. So the depreciation is based on the $100,000. And so we're going to do, we'll do a minus because we want it to be a positive number just because of the way I've set this up. So minus $100,000. And then we're going to, we'll multiply it. Let's make this absolute. So that's function F4. And we're going to multiply it by the MACRS rate. So that's my first year depreciation, 20%, $20,000. So now I drag that across. And so now I have my, I've created my my project cash flows. The only thing I haven't done the calculation for is the salvage value. And salvage value here is a little more complicated than in most cases because I haven't shown here that's the actual amount. But I'm gonna show you how to calculate it. So the this 5.76%, that's it. That's a residual value. So it hasn't been depreciated. So you're not going to have to pay taxes on the sale of that. So we take the $100,000. Whoops. Let's do this start over. Equals. We'll do minus the $100,000 times the 5.76%. So my taxable value is going to be $30,000 minus the 5760. I'll have to add that back when I get to calculate the net value. So taxes are simply the $24,240 times the tax rate. And the after-tax value is $24,20 minus the taxes. So that's, and now we add back the 5760, so equal, right? So the after-tax value plus the 5760, so that's a net salvage value. So these are, we're basically we're calculating our operating cash flows, and then we're adding back. So this, so our operating cash flow is our earnings before interest and earnings before taxes plus depreciation minus taxes is the way I'm calculating it here. So, and then we would, any other cash flows we add back. So these are our project cash flows. So we, over here, I've set up a calculation. Our discount rate here is 10%. Our NPV is $78,532.99, which is exactly what they got in the book. Here I calculate the IRR. So this is the IRR of the cash flow. So I just, all you do is you IRR and you highlight all the cash flows, and it will calculate the internal rate of return of 18.5%. And over here I can prove to myself that the IRR is 18.5%, because what is the IRR? It's the NPV, or the rate that makes the NPV equal 0. So the L15 is the IRR, and C23 through G23 are the project cash flows, and then you add back the initial cost as a negative, and you get the NPV. So the same formula is used for all of these. We're just using different discount rates. So 10%. So at any rate or required rate of return less than 18.54%, we would accept the project. Anything greater, we would not accept the project because we would have a negative NPV. So that's it for the Baldwin Company example.